Australia is officially back in a per capita recession, and there's a lot of speculation around what this means for interest rates as well as what happens with housing prices. Now, another thing that I want to cover off and update you guys on is the current supply levels, and the latest numbers are not good reading. So if you're interested in what my thoughts are, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, as we know, here in Australia, we've been lucky enough to avoid a proper recession purely based on one thing. And that one thing is immigration. A lot of people are hating on life because the government said, we're gonna bring in so many people into the country that we can avoid a major recession. And that's exactly what's happened, because a per capita recession is something we are experiencing. And the difference between a per capita recession versus a full-blown recession is that the per capita recession refers to per person. So if you look at the economic performance of an economy and you divide that by how many people are there, that's why we find ourselves in a per capita recession, not a full-blown recession. Because overall, the economy seems to be afloat. But when you account for all the new people that have come into the country, we are actually falling below the line. So what does this mean for interest rates? Well, let's go and find out exactly what the numbers look like when it comes to the recession, and then what this means for you as an investor. Australia is officially back in a per capita recession, but there could be a silver lining for struggling mortgage holders. According to the latest ABS figures, GDP rose in the March quarter by 0.2% and 1.3% year on year. But that anemic growth was not enough to keep Australia out of a per capita recession, with the nation going backwards by 0.2% per person. The Reserve Bank of Australia could hand down another rate cut when they meet next month in response, creating a glimmer of hope for Aussies struggling with mortgage repayments. Rabobank senior strategist Ben Picton said the RBA will likely decide on back-to-back rate cuts when assessing economic conditions and dwindling household consumption. You can't polish this one. It was a poor growth figure, Mr. Picton told Sky News Business Now. The RBA will look at that and they will be thinking they've maybe got their sums wrong a little bit on what their expectations for what the resilience of the household sector was. Mr. Picton said the nation's safety net was removed a little bit for the economy as public spending decreased. Now what we have here is the Australia's GDP number. So what we can see is in the March and June quarter we had negative growth, which essentially means we entered a recession. And I remember making videos on this channel. There was probably about 100 of you guys watching at that point. Since then, we had a lot of stimulus come into the market, a lot more money coming into the system, and we started seeing some growth. But that growth was short-lived because in 2021, in September, we saw negative growth again. And then again, we inject more money into the system. Rate cuts were a big part of the system at the time. And then we started seeing some positive numbers. Now, what you've seen is pretty ordinary results since then, to be honest. And when you really account for how many people have come into the country during this period, you're going to realize that this is actually really poor. What the RBA and the government's really been holding on to is, hey, look, we're still growing. We have avoided a recession. But in fact, it's because we've had so many immigrants come into the country. I remember a couple of years ago when I was trying to explain why the government's choosing this path rather than a full-blown recession, I got a lot of hate in the comments saying that, well, why would we include so many more people into the country? It's actually going to screw us up completely. And I actually agree. I think that the market needs to be natural. We can't have the government come in and every time they intervene, they only do one thing, which is cause house prices to go much higher. And that's exactly what we've seen. By having high levels of immigration, our housing supply hasn't kept up, and then added fire to the vacancy rate when it comes to the rental supply, because that rental crisis is as worse as it's ever been. Now, the latest building approvals also just dropped, and that number isn't great either. So the building approvals continue to drop, deepening Australia's housing crisis. The latest data from the ABS revealed a continued drop in building approvals for April 2025. The number of total dwelling approvals dropped by 5.7%. That's on top of an 8.8% decline the month before. It's not good, Narita Conisbee said, chief economist at Ray White. It's not really good news for affordability. The problem too is that those numbers are approvals, so it's not even completions, Conisbee said. So many projects, even if they get approved, aren't getting started or completed because of what's happening with the construction costs and labor availability. And this is what I've explained before, is when it comes to supply, you could see an uplift in approvals, but that doesn't mean that you're going to actually have completions. And this number is really important, and I'll tell you why. Because everything has a lag effect. If I go and get approved today for a new house, it's not like I can put up the house tomorrow. So once I get the approval, I then need to get approval for finance. I then need to go and build the thing. And that's probably going to take about 12 to 18 months. That gets me one house. Obviously that number stretches out a lot further when it comes to multi-dwellings. And then if you've got high density living, like the fact that, if you're putting up a tower, it's going to take a lot longer as well of apartments. So while you could get approved for say 15,000 homes, the reality is how many actually start to how many eventually get completed is a lot less than that. And that's why when the government came out and said, we're going to build all these houses, the reality is they're probably not. And that's because we don't have favorable conditions allowing us to promote development anyway. What I mean by that is you need interest rates to be lowered so that people have the capacity to go and build, but you also need rising house prices. Because as a developer goes in, they're going to say, well, in order for me to build this house, it's going to cost me 500K. But every month that goes on, the rising cost of the construction materials means that I need the market to continue going higher. Otherwise, there's no point in me taking on this risk. If I go and say it's 500K today, and then upon completion, it's maybe worth 600K, well, then it makes sense for me as a developer to say, I'll go take on this project. I can make the returns because I'm going to sell it into a strong market. That is starting to shift. We've seen interest rates starting to cut, and we've seen as a byproduct, rising house prices, which is actually a really good thing for when it comes to housing supply. Now, as we know, the RBA's come out and said, well, we don't really care what happens to house prices. We need to keep a couple of things in mind: unemployment, GDP growth, and inflation. Well, one of those numbers is starting to tick over real badly. The consumer price rose 2.4% for the year to April, according to the Australian Bureau of Statistics, leaving the inflation rate unchanged last month. It is the third month in a row that headline inflation has been steady. The market had expected a slight easing of inflation in April to 2.3%. Now, for the RBA to actually make moves, they want the target range of inflation to be between 2 and 3%. We are exactly where we need to be. And that is why the economists and the markets are now predicting there's going to be a rate cut. But how big could this rate cut be in July? A top economist has called on the RBA to deliver a jumbo cash rate cut in July. Economic growth has been weak, and the Australian consumers are continuing to be cautious with their spending. EQ Managing Director Warren Hogan has called on the central bank to act decisively at its next meeting and make an uncharacteristic 35 basis point cut, this bigger than the standard 25 basis point cut mortgage holders received in Feb and May. At this stage, the RBA seems to think a neutral cash rate is about 3.5%. There is no reason to wait. Hogan, who has previously been cautious voice about rate relief, wrote in the opinion piece of the Australian Financial Review. And that is exactly what the market is now looking at. When we go ahead to the RBA rate tracker, we can see this number steadily rise. So a decrease to 3.6% is a decrease of 25 basis points. So what we've seen is this number go from 62% all the way up to now 84%. And if you zoom out and look at the interbank cash rate futures implied yield curve, what we can see is that the market expects that this rate is going to be below 3% in Q1 of 2026. Now that covers off a lot when it comes to where the economy is right now. Rate cuts are obviously going to stimulate more movement in money. And what I mean by that is when interest rates are high, a lot of people put their money into the banks because they get a really good return. As those interest rates cut, people are saying, well, it's not actually worth me putting my money into the bank. I need it to go out there and work for me. That's how you stimulate the economy. So what I talk about here on this channel is about supply and demand. Let's take a look back and see what the supply situation looked like in the December quarter. Now what I have here is the UDIA Housing Index. I've shown this on the channel before. Now it provides a quarterly health check on the state of the new build Australian housing market. Drawing from a range of data sources, the UHI provides timely indicators of changes in demand, supply, and costs for new residential properties across the nation. Now, I made a video on this channel more than a month ago, and what I was referring to was what happened in the previous quarter. And what we can see is that the UHI was at 90.26. What we know is that at 100, you've got a balanced market. Anything below that means that you really don't have the market heading in the direction you need it to. And what we can see is it was coming off the highs here during the lockdowns, and ever since then, it's been a downturn. So where are we now? Well, if we look at the March quarter, we can see that we've gone from 90 down to 88. And what we see is that complete free fall that I was talking about in that video as well. Now, the couple of changes here that is really important to note is that yes, it's gone down by 3.6%, and that's not good reading for when we look at supply. The other thing that we need to consider is that construction costs are starting to level out. However, they're still going much higher. And we can see that it is starting to adjust, but it is still so much higher than where it was, say, 5 years ago. And this will then feed into this narrative that housing is going to be unaffordable because if you want to build something new, it costs you 50 to 60% more today than it did, say, 10 years ago. So when you put all of these data points together, it's really starting to make sense why this market will start heading higher. It's already started in many areas, but we're going to start seeing it in areas that you probably haven't experienced some growth. And that's why it's important that you know where to look, how to look, and what your strategy looks like. Because I know 6 months ago when I was making videos on the channel, I said, look, we're going to start seeing rate cuts. Inflation is starting to taper off a lot quicker than expected. If you're in the market and have the ability to get into the market, you probably want to get in before rate cuts actually occur. Naturally, human psychology kicks in. Right now, we have a lot more optimism and confidence in the market, and that's why people are going out there, reaching out to people like us and saying, okay, I want to go and invest in property, find the property, let's go and do it. What we're going to see in the back end of 2025 is an increase in demand like levels we haven't seen. I made a video on this channel and it's so important because it was referencing what I said 5 years ago on this exact channel about how we're going to see the biggest boom in prices. And at that point, no one really believed me because apparently the world was collapsing. Definitely go check out this video. It is so important. I'm proud that I've even got it recorded because obviously it took a lot of courage to make that video at that time. There was so much fear, uncertainty, and doubt, but obviously things have played out. Now, all we're doing is black and white data points. All the data that's coming out is suggesting that money's going to be a lot cheaper to borrow and we don't have enough homes because people aren't building enough homes. So if you need help with any of this and actually putting this into action with a strategy, book in a free call. I'll leave a link in the description box below. We've got a team of experts that do this day in, day out. They talk to people like yourself, whether it's SMSF, buying a new super, whether it's going out there building multiple properties in your portfolio, whether you're a business owner or you're buying your first investment property. We purchase all across Australia. So if you're interested in getting in touch with us, again, book in that call because it's definitely going to help you get started with speed. I hope you guys have enjoyed this video. If you have, subscribe if you haven't already. If you like content like this, go and check out the 1,000 odd videos I've already got on the channel, and I'll catch you guys in the next one. Thanks, guys.